In this problem, we have a company that buys equipment for $1,000. This equipment has a 5-year economic life and depreciates at a constant rate each year. The company plans to sell the equipment in 3 years for $300. The tax rate that the company faces on its taxable amounts of money is 34%. And the question is, how much money will it get for selling the equipment in 3 years? So what is going on here? Let's start with a timeline and mark here 0, 1, 2, 3, 4, and 5, right? That's the 5-year economic life of the equipment that we are purchasing. Today, the equipment is worth $1,000, right? How would the value be changing? So clearly, as we buy a piece of equipment or a fixed asset in general, which could be a building or some vehicle or a laptop or software, it starts losing its value. It starts depreciating over time. What do we know about how it depreciates? We know that it depreciates at a constant rate each year. What does it tell us? It tells us that between the two methods of depreciation, which are the straight line and the depreciation under the modified accelerated cost recovery systems, it's the first one, the straight line depreciation, which implies a constant amount of money lost every year. So let's put here, it's a straight line depreciation method, right? Straight line. What does the straight line method mean? It means that in order to calculate depreciation per year, you can take the price that is paid now, which is the initial value, right? You take $1,000 and you simply divide by the economic life, which is 5 years. So you divide by 5 years, and what we get is $200 per year. What does it tell us? 1 year later, the value is smaller and it drops by $200, becomes $800. Then another year goes by, the value drops by another 200 and becomes 600. Then after year 3, the value becomes 400, then 200, and then nothing, $0, right? The value drops to 0 after the economic life is used up, end of year 5. So when are we buying the equipment? We are buying it here, right? We buy here. And when are we going to be selling it? After 3 years, right? So we sell it here. Sell here. And so what's important is how much it's worth on the books in the accounting sense. It's going to be worth $400. This is the remaining book value. Remaining book value. And so now when we calculate the money that we get, we need to take this into account. When the question asks how much money the company gets, it may not be necessarily $300, which is what some buyer would be paying us. It could be a little bit more than that. It could be a little bit less than that, or exactly 300. It depends. It depends on the remaining book value. So let's see how the $400 remaining book value changes how much we're going to put in our pocket after 3 years. And so what the question is asking is to calculate what is called the after-tax salvage value. After-tax salvage value. So let's call it ATSV. So what's the formula? What's the after-tax salvage value? We take $300, the selling price, and in this case we are selling for less than it's actually worth. It's like we're selling at a loss. Another thing you can say here is, it's as if it's not really worth $400. Nobody wants to pay us $400. The best we can get is $300 if you sell it. So in a way, this depreciation has been way too low, right? $200 per year, it's as if too little over the 3 years. If the depreciation has been too little, since it's tax deductible, it's been making our taxable income way too high, and so the implication is that we've been paying way too much in taxes over the 3 years, or we would be paying if this is all about the future 3 years, right? And so since the taxes are being overpaid, now when we sell the equipment at a loss, essentially we're going to get a tax refund. So we're going to put plus, and there will be an extra amount that we call a tax refund, right? Tax refund. How much is it going to be? We take the tax rate, 34%, 0.34, and multiply the difference between by how much the remaining book value exceeds the selling price. So 400 minus 300. Okay, so this gives us $100, and the whole tax refund is going to be $34. So we put 300 plus 34, which gives us $334. And this is the answer. And now let me change one number in this whole problem. Let's say we are planning to sell the equipment for $500. What will change? Well, basically, whatever we had 300, it's now 500, right? So we are now selling the equipment for $500, right? We have it here and we have it here. What else is going to change? Now 300 becomes 500, and essentially it's the other way around. We are selling the equipment for more money than it's actually worth on the books, for above the remaining book value. And the same, using the logic I explained earlier, that would imply that we have been paying too little money in taxes over time. And so now it's not a tax refund, it's a tax liability for the firm. The firm will owe money to the IRS. And so instead of adding some extra amount of money, we are going to be subtracting it. So 500, the selling price, minus the 34% tax rate on income, multiplied by 400 minus 500. So that would be a negative 100, and as a result, we are talking about subtracting $34. So 500 minus 34, which instead gives $266. So we end up putting less than the selling price of $500. 500 minus 34. So it's 466. So we end up putting less than the selling price into our pocket.